Grexit, Spexit, who would be the first to leave the European Union, Greece or Spain? Or what about the possibility of Germany jumping ship? We'll be talking about all this with Vince-Lanci coming up right now. Vince-Lanci, the man of the hour, joins me again today. Vince, thanks so much for being with me again.
You're too kind. Thank you for having me.
So Grexit, Spexit, Vince, who will stay, who will go? I believe you've taken the stance that Greece is not going anywhere.
We have. There are two sides to the story, and we've looked at both of them unscientifically, and we believe Greece is going to stay where it is. It's not leaving the Union. We have positions to that effect, and we're not married. It's a fluid situation. We're not married to it. But if you look at the situation as it's going to play out, politics, propaganda, bluffing, the reality is there's going to be a lot of face saving after the Greece elections. The IMF is going to soften its stance, as they indicated today. And Merkel, even though she doesn't have the political backing to be nice to Greece, is going to come up with something to keep them in. Greece can't leave. They have no economy. If they leave, they're doomed. They can't collect taxes. They have no tax revenue. And on the euro side, if Greece left, you'd have a euro-wide bank run. And it's important to note that banking insurance is country to country. It's not nationalized like the FDIC. So it would be pay now or pay later if Greece left.
So Vince, in whose best interest is it to save Greece?
I'm not sure how best is defined in terms of short-term and long-term, but let's just say this: you can't let Greece leave because there is no ring fence or protection. If you let Greece leave, Spain will leave, and that's another whole issue that we can talk about as well. But the reality of it is this: if Greece leaves and defaults on their bonds, you would take down the e.c.b. You would take down the French banks that have bonds on them, unless, of course, Germany printed money, which they're going to have to do either before or after. So they can't let Greece leave.
All right, Vince, so let's go back to Spain for a second. Why would a Spexit be more likely to happen?
It seems to be based on the size of their debt, the economy, they have one, and the third one, the nationalism. So Spain feels it has a real economy that can survive an exit. The export to GDP ratio is 26%, roughly what the UK and Italy have. So they have a real GDP. Sorry to insult any Greeks out there listening. There's a sense of nationalism, an international nationalism. They look to Latin America as current and growing trade partners. So they might have a better chance of exporting their way out of it. The other thing is they are too big to rescue, I think. And if you look at what happened with 2 days ago, Madrid submitted an idea for helping rescue Bankia. I'm not sure I'm saying it right. And Germany outright said no, or the E.c.b. said no outright to the idea. And the next day there was a run on the bank, and now they have to bail it out. And the bailout for Bankia is what, 19 billion euros? So pay now or pay later. If the other banks go under, as the recent Goldman Sachs report estimates, there'd be no way they can rescue Greece. Spain. Spain's too big to rescue if there's a bank run. So Germany can't stop it if Spain wants to leave, and Spain is more nationalistically proud right now than Greece.
So Vince, what's the probability then of Germany saying, you know what, guys, we've had enough, we're out?
Yeah, you can't quit. You guys can't quit. We're firing you, and launching a Deutschmark. You could see why on some level they may want to do that because they are the producer. They are the strong hand at the table. They are the shoulders that everything is hanging on. The first reason they wouldn't do it is because, well, if you were to do that, you would need trading partners, and the other countries just wouldn't trade with them. You'd start the things that start wars. You'd start trade tariffs, trade barriers. They would need to start selling more cars to Russia. As of right now, they're working on deals with Russia where natural gas, where they're working on, say, a currency medium where part of the currency is priced in natural gas. It's not very public, but it's out there. So Germany receives natural gas from Russia. Germany sends BMWs to Russia. But, their trading partners would shrink drastically, and they would have an extremely deflationary economy. They wouldn't be able to export anything. So I think it would be bad politically. It would be bad for their economy. And certainly the country that they claim to be friends with now, France, would just sink because France has all the Greek debt. It would be crazy if they did that. You want to buy a black swan event and hope and maybe that would happen? Sure. But if you're right, you should be buying guns, not wing calls or wing puts. It would be crazy if that happened.
So Vince, just when we thought we would no longer speak about Europe, it's the only thing we're focusing on these days, and rightfully so. But let's bring it home to the metals now. What are you seeing on the gold front?
As we've said ad nauseum for the last month, gold is a commodity for the moment. And that means the European banks are liquidating gold every time the euro weakens because they can only sell things that they have and that have profits. So the euro drops, the dollar strengthens, and gold acts very much like a proxy for the dollar. So gold goes down. So you can just picture the euro's dropping and some French housewife is selling her necklace, just to put a face on it. But what we're noticing is that while we think this will continue, we're seeing moments where it's pausing and reversing. There is a price which we've given to you before. Above 1525, we're okay with gold being long as a spec and taking delivery. Below 1525, we have a problem, and our reasons are as follows. Aside from a technical chart that just points that obviously, there is a big buyer or buyers between 1525 and 1535. There have been moments during the trading day centered around the European trading hours where gold will diverge from the euro and you will start to see gold to act like a competing currency. It doesn't happen for very long, and it's something to be ignored usually. But on Wednesday, the Wednesday trading day was an extreme example of what we're talking about. We sent you a graph of a 60-minute chart, euro versus gold. And in the big gray box are the European trading hours, roughly midnight to noon U.S. time. And during that time, they both move in lockstep going down, even with some subformations forming. However, the moment Europe closes, the euro continues lower and gold just goes higher. So that's a sign that Europeans have stopped selling for the day. That's a sign, and we had actually approached the 1525 to 35 area. That's a sign that the people buying because gold is money and not a commodity are back in. And Thursday, as we're taping this, it's happening again. Not so black and white, but gold started higher with the euro lower. And it had a quick washout on a PMI number, but now it's holding its own again. The bottom line here is at some point, gold will become a currency. It will be treated as a tier one capital asset for bank balance sheets, and it will be an alternative to the euro. We don't think the euro is breaking up. We do think diversification in currencies is coming. One thing we like to caution about, though, is below 15 and a quarter, you could have that 1350 washout. We say it because I don't care what you own. If it's leveraged, it will go down in a deflationary spiral. If it's the King James Bible signed by Matthew himself, if you bought it on margin, it's going down in price during a deflationary spiral. And that means paper gold will go down as well, because people need money, and if they're borrowing 10 to 1 to put something on, they got to take it off. And so gold will wash out if news comes out and that 1525 area doesn't hold. That's when you want to reach in with both hands and buy everything you can. So buy some now and buy some underneath 15 and a quarter physically. Leverage is bad right now. They don't want you to have leverage and they will force you out.
Vince, I never asked you about crude oil, but this week we did see it enter into a bearish territory. Were you surprised by that?
No, we really weren't. The decrease in the euro, one of our models called for, well, at the same time we got a sell signal in, we put in a report out on the Cameron Hanover site. We got a sell signal in crude oil, gold, the euro, and a buy signal that hasn't worked out so well yet in natural gas. But basically, a weaker euro, just to put it in fundamental terms, a weaker euro means less buying by Europeans, which means less which means less demand for commodities, which means lower oil prices globally.
All right, Vincent, if I could just add my 2 cents today. I remember when I started covering the markets about 4 years ago and the European crisis just started to emerge, gold was responding positively to that. And I remember when I was interviewing analysts at the time, they were saying, yes, gold is going higher because of this crisis emerging in Europe. So it really seemed that the fundamentals were playing in gold's favor. Now, not the case at all. So that I do find a bit surprising.
You're right. You're not wrong. And if you take a chart and you look at it, there was this gold moved opposite the dollar, period, until about August of 11. And then it started moving with the dollar, competing with the dollar for assets as people deemed the European crisis worsening. Now, was the European crisis worsening to warrant gold going up? In retrospect, Monday morning quarterback, you got to say no. Someone thought it would go up, and so they bought it. And I think this is when Paulson was buying. Paulson was adding to his position, buying on the dip, buying on the rally. He was just buying and buying, and basically, for a 6-month period, you saw gold go up with the dollar and say, gold is now a competing asset for a competing currency with the dollar as a safe haven. And then in December, margins got lowered, got raised, crushing that relationship and getting the speculators out. And I think Paulson was one of them. So now I think what you're looking at is a market that has less leverage, less speculation, and sadly, if you're a gold bull looking for the end of the world, gold is now moving as a proxy to the dollar again, and will continue to do so because Europeans with a weaker currency need to sell everything. And what you're looking at is, to sum it up, it's an irrational trade. You own a house, right, and you have no cash. Your house poor. So what are you going to do? What are you going to do for money? You're going to do like they did in the Weimar Republic in the 20s. Inflation it's not because of inflation yet. Inflation is screaming. So what do? Sell the piano, sell the chair, sell the things that are real, that have actual value, but sell them at ridiculously low prices. And who's buying in Germany? The French, walking across the border, buying all these things for pennies on the dollar. And gold is an asset that's being sold to raise dollars. Sell the thing you have profits in. So at some point, you're going to see a recoupling of gold with the dollar moving up as an alternative currency. And I think the chart that I showed you said that people are starting to believe that again.
All right, Vince, thank you so much. I might not see you next week since I will be covering the IPMI in Las Vegas next week, but we hope to see you soon.
Bye-bye, Daniela. Thanks for having me.
And thanks for watching this edition of Reset. You can email me at newsfeedback@kitco.com. For Kitco News, I'm Daniela Camboni.